Mike Larson with Weiss Ratings, and I'm here with Jay Hatfield, CEO of Infrastructure Capital. Jay, how are you? Welcome to the show.
Thanks for having us. Appreciate it.
Now, from what I understand, your firm is very focused on income investing in preferred stock and things like that, ETFs that provide greater yield. Can you maybe start out by talking a little bit about the interest rate environment and what kind of challenges that brings up for an investor?
Right. Well, notwithstanding the coronavirus, which has caused rates to actually go to their lows, about 150 in the 10-year, we have been projecting that global monetary stimulus, about 95% of the global economies are stimulating. That normally, over time, would raise interest rates to, say, the low twos is what we're projecting. And for Treasuries, munis, and investment grade, they could actually suffer losses. But spread products, so that would be high yield and preferreds, would actually normally do well in that environment if the stock market's higher and rates are also higher. So that's why we've been focused on those two asset classes, and we have ETFs in the preferred sector, and those have been performing well in this kind of environment.
Sure. Now, you mentioned the ETFs that your firm has. Can you talk a little bit about the one that you were discussing earlier, the preferred ETF, and sort of how that works and what your approach is different there versus some of the other products that are out in the market?
Right. Well, with fixed income, so PFFA is an active preferred fund that trades in $25 listed and liquid preferreds. Okay. And the reason it's critical to have active management is they're callable at par after 5 years, so you don't want to hold them when they're above par. If you look at the big index funds, they hold about 20% usually that are callable par, so they'll lose money when they get called. Yep. So we're able to sell them and then look for better credits. And also, we have a tight credit screen because you don't want to be in preferreds that are distressed, because in bankruptcy they do very poorly. They get wiped out usually. So we think fixed income, it's more compelling to have active management than equities.
You know, and that's interesting. When we were talking off camera, you mentioned something about if you own a bad stock, that's one thing, but if you own a bad credit, that's another. For people who don't know, what is the difference? Why is it so much more important to focus on that?
Well, because equities have unlimited upside. So, like a company called Rite Aid comes to mind. Looked like a super low quality company, in trouble, but then they turn their operation around. The stock goes from 3 to 30, or at times 20, 30. Whereas bonds are capped at par. So heads, you get par, tails, you get zero in a back credit. So you want to have a quality screen where that doesn't necessarily work with common equities, because the lowest quality companies can do the best in an up market.
Yeah. Well, Jay, what website, what can somebody go to get more information about your firm?
You can go to Infracap Funds or Vertis Funds and get more information about our products.
Perfect. Well, thank you very much, Jay. Thank you much, viewers. Enjoy the rest of the show.
Great.